Okay, so hello investors. It's Don Vandenbord, Portfolio Manager at Revere Asset Management, and welcome to today's Lunch and Learn webinar. Today's topic is riding the wave, watching for inflection points as the market tries for new highs. So remember why we do these. It's not how much you make in the market, it's how much you can keep. And at the end of the webinar, we'll do Q&A and charts on request. Reminder, our website, revereasset.com, tons of information out there. We do videos 5 nights a week and a podcast, a video or audio podcast on the weekends. These webinars are all archived on our YouTube channel. Just go to YouTube and search for revereasset.com. And reminder, this is for educational purposes only. I'm not suggesting you buy or sell any stock. I'm just pointing out the process that we use at Revere to recognize the trend of the market, get in the leading stocks in the leading sectors, and participate as long as the market is in our favor. And when the market falters, we get out of the way and protect capital. Again, it's not how much you make, it's how much you keep. So growth investing and surfing have a lot in common. In surfing, you see a wave, you start paddling, you climb up on the board, and you're not sure how good the wave's going to be, how long you're going to be able to ride it, how long it's going to be available for a ride. And it could be the perfect wave, and it could be that you just don't know how to handle the board or handle the wave. And so you could be the surfer that falls off, even though it is the perfect wave. But what we're doing is presenting a framework that we use to try to ride these waves as long as we can, participate in them. And when the wave dies, we paddle back out, wait for the next wave to come in, and then climb back on and start the process again. So what I want to do here is start out with, let's bring up the agenda here. And we're going to walk through a little bit of background. I'm going to talk about bear market stats and why this is so important. Back at the beginning of the year, I did, actually, I think it may have been in December, I did a study of the prior 11 bear markets. At Revere, we came into 2020 with the mission to stay clear of the bear. Really didn't know when a bear market would show up, but we wanted our followers and investors and our clients and to be prepared to lock in the nice gains that 2019 gave us. Little did we know COVID was going to hit with the ferocity that it did and just absolutely crush portfolios. But the prior bear market stats that we put together gave us a good framework for what to expect. And quite simply, that's our approach to the markets. We, as long as we're participating and the market is trending higher, the key line in the sand for us being the 200-day moving average. And the concept of sequence of returns. The market returns about 8 to 9% a year, but you don't get that every year. And the market isn't on your time, you're on the market's time. And if you're approaching retirement, and suppose you were getting ready to retire in 2007 or 2008, and you got crushed in the market through no fault of your own, but if you either had an advisor, you didn't have an exit strategy, your nest egg could have been devastated. So this is what we try to guide the people that follow us through. We just don't think that buy and hold is a viable strategy without having an exit plan. So riding the wave, the analysis of the last 12 bear markets. Ironically, the stats from number 12 that we just had here in the first quarter lined up very closely with the prior 12 markets. And it reinforced what we preach every day, that the market does not get into serious trouble unless the S&P 500 breaks the 200-day simple moving average. If you're as hands-off an investor as you want to be and you just invest in index funds, and there's some people that really don't want to do what we do, but following this one simple rule, if you get out of the market when the S&P 500 has a weekly close 1% or more below the 40-week or the 200-day moving average. They're pretty much synonymous depending on whether you're looking at a daily chart or a weekly chart. You just get out of the way using that sell rule. And then, of course, the buy and hold people say, well, you got to know when to get back in. Well, buy that weekly close 1% or more back above the 200-day moving average. The results of those bear markets, there's been 12 of them since 1968. The average bear market drawdown is 33.5%. Let me bring up this stat very quickly here, and I recently added the stats for the 20th or the 12th bear market here, February to March. Its drawdown was 35.4%. The high to sell drawdown is 11.3%. It was 11.5%. And adding this drawdown of the last one, this is using this rule from the top. You sell a weekly close 1% or more. The average high until you reach your sell means you're going to lose on average 11.3%. I think it was around 12% on this one because we were so extended above. But the point is, this is a target for a drawdown before you exit the market. There's no reason to ride it down 20, 25, 30 or more percent. Using this rule, your high to sell point is going to be an average of 11.3%. And then this sell saves an additional 23% of pain until we bottom, because the bottom, the average drawdown is 33.5%. This most recent one was 35.4%. And it saves you 23% off the bottom. And then where are we going to re-enter? On average, it's going to be 8.4% below where we sold. So we're that much ahead. This was one divergence from the normal. It was about 5% higher than we would have exited in this COVID, because the bounce back was so quick, as well as how fast the sell-off was. The correction was, the bounce back was just as quick. So using this rule, you would have gotten back in above where you sold, but to us, that's a small price to pay. Again, on average, you're re-entering 8.4% below where you got back in. So those are the stats. This is, really why we do what we do. Let's talk about a 2020 review now. So let's keep our agenda up here and look at a chart of the S&P 500. I'll bring up, that was the SPY. Here's the S&P 500. So the rally, this shows back the prior 3 months of October all the way through December. Now, 2019 was a very strong period in the market. And we were riding this rally up, wondering where is the top going to be, and we wanted to be prepared for the top. The top was right here at the end of January. Actually, it wasn't the end of January. That was a pause where we came back and tested this red line. This is the 50-day moving average. From following the trend gauge that I use, I invest across a short-term and intermediate term and a long-term. The green line is the 21-day. When the indexes are above the 21-day, this is when we really want to be as long in the market as we're comfortable. If we break the 21 and still hold the 50, we're going to pull back a little bit, but we're still in good shape. And it's not until we break below this black line, the 200-day moving average, that you absolutely want to be away from the market. So COVID rumblings started in mid to late January. We continued to ride it up okay to February until we had this hard break on February 24th. So this was a big gap down in the market. We ended up down 3.35% on the day with heavy volume. This is when COVID was really starting to hit home. We broke in the same day the 21-day and the 50-day moving average, and we started selling some stuff in here. We actually lightened up a little bit around this area because some leaders weren't really acting well. And then you can see the next couple of days the selling continued, and then we had a break below and a close below the 200-day moving average on 227, 228. So this was our signal to get out. And then the next week we bounced back. So you're thinking, why the heck did I get out? But this was just a feeble attempt at a bounce, and we ended up rolling back over again. And then when we broke below this low, this is when things really got devastating, all the way down to this period on 323.20. So from 219 to 323, 4 to 5 weeks, you can see we dropped 34%. And then, of course, the people that say you can't time the market, they need to know when you're going to get back in. So we got so extended down from the bottom. And again, we used a 21-day exponential moving average here to signal our participation. So William O'Neill were disciples of his, and they have a concept called a follow-through day. And what it is 4 or more days off the bottom. After a bottom is made, you look for the market to have a strong up day on above average volume. So we were looking, taking a couple of positions in here, and then we had this ugly 3-day gap down. And the market, no matter how the next 2 days, it tried to break below this. We were positioned very lightly. In fact, I believe I was waiting for a break of this and we were going to go lower, but that break never came. And it's okay to be wrong. It's not okay to stay wrong. That next Monday on 4/6, when we had this big gap up, we cleared this area here from late March, got back above it. That got us back above with a close below. Closed back above the 21-day exponential moving average. So it was time to start putting the short-term money back to work. The long-term money, we're still below the 200-day moving average. Intermediate term, we're still below the 50. But using a relative strength, we had our list of leaders and we started buying them. The next day was an ugly reversal to the downside, but the market couldn't go any lower, and strength came in right after that. We made a higher high, a pullback, got into the 50-day, and this is where resistance started, the declining 50-day moving average. That's this red line. But the pullback held at this key 21-day, and then we started making higher highs. We got up to the 200-day moving average. This was our first attempt to clear it. That failed. But we pulled back, and what happened? We held the 21-day exponential moving average again, started to rally back up, tested the 21, one closed below, but that's it. We closed the second day back above it. Then another gap up, sideways for a little while, and now back above the 200-day moving average. We got our weekly close back above it. So as we got back above the red line, the 50-day, some more intermediate term money could be put to use, and then finally above the 200-day. Now we're looking, there was some very strong leadership during this process. Software stocks were leading the way back up. There were a bunch of COVID or stay-at-home type stocks that were really acting well, and we rallied into this 32.33 level. Then the next attempt at a shakeout on 6/11 got us big gap down back below the 21-day exponential moving average, but only one close below. As we got near the 200-day, we don't panic here. We want to see that weekly close below to get out, and we never got it. So we had one close below, another test back above it, another test back above it, and then we pulled back slightly again. But again, the 200-day held. The 50 started coming back above the 200-day, got back above the 21. And this is why I use the 3 time frames. When we're above the 21, that's healthy. When we're above the 50, that's healthy on an intermediate term. And then back above the 200-day, as long as we stay above there, we can have our long-term portion of the money in the market. And then this very strong rally above the 21-day exponential moving average all the way to where we just got too extended at 35.88 at the beginning of September, 2 tough down days. This is where the current correction started, and we started pulling back. We sold a few things, held the 50-day moving average, then we bounced back up and the 21 rolled over. Now we have the chance again for the market to really go to hell, so to speak, but we're going to stick to our rules. As long as we're above the 200, we want to be invested somewhat in the market on our long-term money. So we're above the 50-day, we want to have our intermediate term allocation. And as long as leaders are acting well, that certainly plays into this too. So a couple closes below the 50, we get a big gap up. back above the 50-day moving average as we start to try to form the right side of this current cup and handle that we're in. And nice 2-week rally, a top put in for now as of 12/10. So this was a 10% correction on the S&P, a 13% correction on the NASDAQ, and currently we're pulled back about 3 to 4% here, but we continue to hold the 21-day exponential moving average. And if you've been watching the nightly videos, you know I've been talking a lot about this area on the S&P 500, this 3,400 to 3,430 level. Where we were range bound for a while. You want to use ranges as well as moving averages, and when they line up together, it provides additional support. But we got back above this 3,430 level, rallied back up, tested it here, 3,430 on a pullback on 10/15, but held it, rallied back up again, and then last week a harsher pullback that undercut. Got into this range. We had a close below 3,430, but it still held 3,400. So one day back in the range, the next day we gap back up. So we held the 3,430, and now we've had another pullback today, and the low today was 3,433. As of right now, we're trading at 3,439, which as of is 12:20 Eastern on 10/21. So we really need this 3,420 to hold, and then the next level down is the round level at 3,400 before we get back into this range again, and that's really a loss for the bulls if we get back into this range, coincident with some weakness that we've been seeing in some leading stocks. Really today, they got extended, they pulled back. I talked on Monday's video about how I sold a few things, lightened some things, and I use this chart to determine how long I want to be in the market. And it's taken me years to put this together. And basically, as long as we're above the 21, the 50, and the 100, and the 200, I want my beta to be between 1 and 1.5. If leaders are really working, for me, a full allocation would be 1.5 versus the S&P, which is a 1. We break below the 21. Now I'm going to start selling things. Right now I'm sitting about 1.1 as we're above the 21. A couple clicks of the mouse, I can be right back down here. If we're above the 50 but below the 21, between a beta of 0.75 and a 1. If we break the 50-day, 0.5 to 0.75, we break below the 100-day. We're still above the 200-day, so between 0.25 and 0.5, and then of course if we break the 200-day and start trending below it, we either want to be near flat or net short. And then this is the re-entry. If we get that follow-through day that I talked about, we can start tiptoeing back into the market and start adding exposure between 0.25 and 0.5. So if you don't calculate your beta individually for your holdings, you can think about this as a cash position and multiply it by about 1.25 to 1.5 because growth stocks are that much more volatile than the average stock or the the S&P 500. So that's where we are. I talked about the rally, the top, the warning signs here, where we initially broke the 21 and the 50-day moving average, the escalation lower in the bottom to where we went down to the 323 bottom, and then our reentry plan where we started bouncing back up. We look for the follow-through day. We get back above the 21-day moving average on the indexes. Here was the June pause where we had about an 8% pullback, but held the 200-day moving average, and this is the current consolidation that we're looking at right now. The cup with the handle pulling back and holding that key area of the 21-day moving average, the 50-day moving average, and that coincides with the 3,400 to 3,430, 3,440-ish level. And just in the last couple minutes since I started, we've been rallying back up. So let's talk about some individual stocks and how well they've really worked. And this is why we invest in growth stocks. This has been one of the strongest markets for growth investors that uh, I've seen in years. Really, you often get short bursts of time that are like 2 to 3 months long, where you get some leadership, but the breadth of leadership and the strength of leadership has really been remarkable. When you consider stocks like Zoom, here we are coming out of one of the worst bear markets that we've ever had in the indexes, while Zoom is just going sideways because necessity being the mother of invention. This is video chat and got extremely popular. This doesn't look like it much on the market, but this is um, going back and forth between 100 and 160. Then they had a big earnings report, and this is where it really broke out. And then since then, it's gone from 180 all the way up to 600, including this massive move up on September 1st. So here's a stock, call it a stay-at-home, a COVID stock, has gone from 160 to 600, and these are the types of moves you can get in extremely strong growth stocks. Another one is Teladoc. Uh, you can see again how the relative strength was fantastic on this while we were in the COVID period. So this has gone from 100 up to 250 before it started its current base, and it pulled back while it bought LVGO. So it's trying to digest that merger. DocuSign, another one, people working from home doing remote documents. This works for individuals and businesses. A huge run from, and again, look at the relative strength, how it's climbing this is what the S&P 500 is doing while this stock is basically going sideways going sideways in price, but showing extreme relative strength because people are starting to use the product. And that's the N in William O'Neill's CAN-SLIM acronym, something new. This is what drives sales, which will ultimately drive earnings and drive the stock higher. And you can see from a relative strength standpoint, when this finally broke above 100, it peaked, had a little bit of a climax run here all the way up to 290 as it's forming a current base here now. So a lot of stocks are doing this, forming this base. And again, this is just because this is what the major indexes are doing. Here you see a cup and handle being formed on the NASDAQ 100 now. We're in the handle portion of it. Let's go to the 60-minute chart here, and you can see the lows of the last couple of days are very critical. We don't want to break back into this consolidation range, which was around 280, 250-ish. Right now we're at 285.70 on the NASDAQ 100. So very crucial that the lows of the last couple of days hold. And if so, this could just be the handle that we're putting in before we head higher. A factor to look for on how this resolves could be what happens with the big FANG type stocks. And they've been pulling back lately and putting in their own handles. The first one reported last night being Netflix, and it really wasn't a good reaction right now. It's down 6%, broke below its 50-day moving average. Let's step through these big NASDAQ type stocks. Facebook got a couple of upgrades today, so it had a little bit of a gap up. Again, you can see it forming this cup, very similar to what the NASDAQ 100 and the S&P 500 are doing. Here's Amazon. A lot of these have earnings next week. Amazon, another one forming the cup. The pullback's been a little bit more harsh than I would like to see. In fact, we've broken below the 50-day now on this. So we really don't want to give back too much more there. I mentioned Netflix. Google just got hit with the Department of Justice antitrust. So, of course, it's up. Does that make sense? Not really, but you follow price, not necessarily what's going on. And this has really been a relative strength winner over the last 2 weeks, completely contrary to what you would think. Another one that has earnings next week. Microsoft is in this big NASDAQ 100. I'm going to go through the top 10. You can see it also forming a cup and handle. Apple, another one forming this cup and handle. Nice pullback sitting on the 21 and the 50, but they've got earnings next week also. So these earnings reports are really what's going to tell the tale as far as what happens to the NASDAQ 100 and whether or not we see rotation into more defensive type stocks, which we've been seeing a little bit lately. Another one, NVIDIA, that's in the top 10. You can see it a little bit higher up in its as it starts to form the handle to its cup. Tesla has earnings tonight. It's been pulling back right around to the 21-day exponential moving average. Adobe, another big software stock that's in the top 10, putting its handle in. And finally, PayPal, which had a night that they announced that they're going into crypto similar to the way Square has. So this has a very nice high volume, 166% breakout of its cup and handle today with relative strength at a new high. This has all the characteristics that you're looking for in a leading stock. And it doesn't have earnings until, well, you got a couple of weeks until 11/2, but near all-time highs with relative strength at new highs. That's what this blue ball means. Big volume, up over 5%. This is institutions buying the stock, plain and simple. So that's the top 10 of the NASDAQ 100. I pretty much, let's go back to the agenda and, what's next? We're going to let the wave decide for us. We're riding the wave right now. We've got a little bit of a hiccup in this current correction, which was 10% deep on the S&P, 13% on the NASDAQ. Our portfolios pull back slightly less than that, but we're going to let the wave decide what our next move is going to be. And it's going to be very simply applying the same rules that we applied to, let's go back to Q4 of 2018, the last time we had a bear market, and we applied the same rules over here. This is Q4 2018. The first break, we're riding up the 21-day very strongly. We have break of the 21 and then a harsh break of the 50-day. That's the red line. We come all the way down. We bounce at the 200-day before we finally roll over, attempt to bounce again, come back, attempt to bounce again, and then finally give it up in December. And this was a 20% correction during Q4 2018. And then we're going to follow the same rules. We're going to look for a bottom, and then the 4th to 7th day off the bottom, we want to look for leading stocks that are outperforming, starting to act well. The indexes get back above the 21-day moving average as we start to dip our toes back in, then see what happens when we get to the 50, and then finally see what happens when we get our long-term signal. Here we hit the 200-day, pulled back once, got back above it, then pulled back one close above it before we started another rally before we had this next correction. But notice with this correction, we never got the weekly close more than 1% below the 200-day moving average. So it didn't count as an exit point. And then we bounced around during 2019. Let's get this back to reset today. Closed 2019 with a very strong rally above the 21-day moving average before we rolled over and got to the COVID correction, which again, we're going to apply the same rules. What happens when we touch the 21? What happens if we break the 50? And then what happens if we get to where the 200-day moving average is and we finally break that? So it's a matter of ebbing and flowing along with what's going on with the market. So right now, we had a nice rally off the bottom of about 7 to 8%, but couldn't get above this prior 35.88 high. So that's when the current handle started to come in. One thing I definitely want to point out is that small cap growth stocks. Here's the IWO. This has really been leading since the beginning of September. I know pulling back today a little bit, but from a relative strength standpoint, you can see that the small cap growth is above its prior COVID high, where the S&P 500 got back above it and then corrected back below and hasn't reclaimed it. So here you can see the move back above the correction. We haven't gotten back above that high, but mid-cap stocks and small cap stocks, here's mid caps. They haven't quite gotten back above it, but the small caps are the real leaders. But they were the real laggards also. You can see from how bad relative strength was here. So IWM, not to its COVID high, but above its COVID bounce high. So this is the relative strength over the last couple of weeks that small caps are showing, and in particular, IWO. This is small cap growth, and IWN, as in Nancy, is small cap value. You can see just not as strong, still well below, and didn't get back above its COVID bounce highs, still below it. But again, forming a big cup and handle, and small cap stocks have underperformed for a significant period of time. So it's going to be a matter of us of just applying the rules relative to where are we horizontally as far as consolidations are going, and then how that plays out relative to the moving averages. So that bounce that I talked about is about 0.5%. We've given that up and we're back to near the flat line. So a lot of volatility going on here. That volatility and those two negative reversals last Friday and on Monday are what led me to drop the beta from the strongest portfolio, or the strongest and most active and most aggressive portfolio that we run, dropped it back from like a 1.3 to a 1, added a little bit since then, but by the end of the day, we could be back near 1, and seeing how we handle this level. Again, this is a very key level, this 3,400 on the bottom, and 3,330 to 3,340, so about a 40-point range, a little more than 1%, and you can track it best using the S&P 500 or the SPY and the 60-minute chart. This is the line that we need to hold. So it's around 3440-ish to 343, and then 341 was the low from Monday, and we bounced on Tuesday and Wednesday. But those bounces, if we go to a smaller minute chart, a smaller time frame chart, here's the bounce Tuesday, another bounce, and then we sold off into the close. We bounced early Wednesday. Now we're selling off. We actually made a new low, another attempted bounce back here, this 342, and then this low around 341, and then down to the next level, it's 340. So you just take it a level at a time, but we don't want to start living in this range again that we can see on the 60-minute chart, which goes all the way down. Let's bring up the S&P 500. This was a failed week and a half breakdown below it, below the bottom of this 3,300 area, and then once we got back above it, challenged the top. 3,330 was resistance, failed here, got back above it, rallied up. Now we're testing to see if this former resistance is going to hold as support here in this 3,400 to 3,430-ish area, and it really needs to. Otherwise, we're back in this sideways consolidation chop, and that would get us off of being in an uptrend as this most recent attempt at a breakout from this horizontal base, and a break that's also going to coincide with a break of this 21-day and the 50 moving average, and the combination of rules, selling in the leaders, horizontal bases and that type of support, and then moving average support. If those are violated, that's how we flow like water, as Bruce Lee would say, or bend like a tree in the breeze, as William O'Neill was fond of saying. So let the market decide. That is, again, that's our decision point, and most of the people that follow us kind of already understand that, and we're glad we can help people be a guide to help people navigate these type of markets. So let's go to anybody have any questions? I've got one so far, but feel free to type some questions in the question box. The first one is, in your condition/beta chart, are you saying beta equals your exposure to stocks, or do you mean you choose high beta stocks? Yeah, it means I choose high beta stocks. I kind of calculate a beta on my own. It's kind of an adjusted beta by looking at what the average true range is of the stocks that I own. So that will show how volatile they are relative to the S&P 500. And then look at the actual beta itself, which means how does it move relative to the S&P 500. So I use that to give each stock a kind of a value on the beta chart. Even so, if the beta says it's 1, but its ATR is 1.5 times or 2 times what the S&P is, I'll add a little bit more to it. And using that is how I calculate it, and that's how I get up to an adjusted beta of a 1.4 to 1.5 if the market is acting well and leaders are acting well. So I hope that answers your question. Any other questions, go ahead, or if there's any charts that you want me to take a look at, any particular tickers, I'd be glad to look at those too. Let's talk about something that that I added last night and this morning, Snapchat. This is following a model that I've used many times, a big breakaway earnings gap on massive volume. Let's look at a weekly chart of Snapchat, and it's at all-time highs. This means anybody that has ever owned Snapchat is now positive in it. So they're going to be hesitant to give up their shares, and that's why people have to bid it higher to try to pry the shares away from them. And a massive gap up on a very positive earnings report. You see volume plus 1,690%. And it's up 33% today. I added a little bit after hours and a little bit more at the open today. And this one acting exactly the way we want it to. And then gap rules, I did a webinar on gap rules. If this is going to work, it should never break back below. And when I say never, I mean never. It may never break back below this low of today. And if you don't believe me, you can take a look at Facebook going all the way back to 2013. This had this situation here with Facebook. It had a very similar gap up 30% on 7/25/2013, and it never in its history again broke the low of that gap up day. So it's very telling when stocks gap up out of a base to all-time highs on massive volume, plain and simple. That is, and how confident am I? I don't guess one way or the other whether that snap move is going to fail or not, because if it does, I'll be out with a break of today's low by 1% or 2. I don't even try to judge whether or not it's short covering. I know Snap has about a 16% short position, and that certainly factors into shorts covering are going to pump that up, but it just continues to go higher and higher, and this volume is a massive tell. This is Wall Street being offsides and looking for the next big thing. Growth managers, momentum managers, they just they buy these and they want to get a position in them, and if they're underinvested, they're going to get questioned as to why they're underinvested, and they just can't miss things like this. Doesn't mean it's going to work. The market could roll over tomorrow. If it breaks the low, I'll be out with a very small loss. Next, let's see, we got a couple of other questions. Let's see. How do you evaluate group strength, weakness, trend, and relative to individual stocks? Rate of change of group, does that play a role? It absolutely does. We just had Hunter Mozingo join our firm. He's as an analyst, he's helping crunch a bunch of stats, looking at the relative strength of different groups, how that changes daily and weekly and monthly, and targeting the leading stocks in those sectors. And we should never miss a group or sector move as we stay on top of it. Do you adjust beta lower during uncertain news cycles like the current stimulus/election? A lot of that depends on how leaders are acting. Leaders have been fine up until the last that reversal on Friday off the highs. We had 2 negative reversals. That makes me question some of it, and that's what had me ratchet the beta down closer to 1 at the beginning of this week. Please look at Shopify. Shopify is one that's on my list, as I've traded in and out of it a couple times, and this is very similar to what's going on with the NASDAQ 100. It's putting in its handle right now, bounced at the 50-day moving average and this 1,000 level. If this is going to be, and it has earnings in 8 days, but you really don't want to see this break below 1,000 or today's low. So it's got the 1,000 level, it's got the 50-day moving average. So double support there, you really don't want to, and it's also today's low, so you really don't want to see it break below that. GLD, after gold is really just forming a nice long base here, this 173.77, the bottom of the base, when it broke the 50-day moving average, we got out of it in most of the accounts that we held, except for some asset allocation robo accounts that we hold as long as it's above the 200-day moving average. But this gap up today, back above the 50-day and back above this recent high at 181.17, you want to see it sustain that move back above there. This 180 level is key. You can see how 180 was support all throughout this area as it was trying to build the right side of a cup, but then it failed and gapped below the 50-day moving average in that 180 level and really hasn't been able to get back above and stay back above it. So if you can stay back above this, stay above this 180 level and stay above the 50-day moving average, and then the 21 will come back up through the 50, and this would be a viable investment again. And also notice it's been showing relative strength over the last week and a half. Datadog, this is something that I own right now. Very disappointing action today. It's broken below the 21. We'll see what happens near the end of the day. This was a very big move up on a Microsoft collaboration here where it broke out. This is where I bought it. Had a very quick 18% run, but it's given all of that back and testing the 21. As you know, with the growth stocks that I own, I try to stick with my position with them as long as they're above the 21-day exponential moving average. If this breaks here and below 100, I'll absolutely be out of it. Snap, well, I answered that. How do you approach recent IPOs? Do you wait for an initial IPO base or do you generally stay away? I do generally wait for an IPO base. Let's just go through a couple of them like Snow. Never buy on the first day. That's a way of separating retail investors from their money because of the hype that goes on these quote unquote hot IPOs. You wait for it to form some sort of a base and come up the right side. This is a nice day in Snow today. It's a computer software enterprise stock, and it may just be that people are trying to establish a position and money flowing into this, and some of that are the prior leaders. Every time a new leader comes to the fore, the money's got to come from somewhere to invest in it, and it comes from selling other sectors or other stocks. But this move back above this 250 area is very bullish. It should hold that on any pullback. Another one, recent IPO is Frog. Same situation. It's kind of forming this U, this first base. If you'll notice, I've got an alert set at the high of 2 days ago. These are very volatile, so position size accordingly. But this move above 80 was bullish. Now it's pulling it back. Let's see if it can hold 80 on that pullback, hang around there for a little while, and maybe put in a handle. So yeah, I look for them to form a base. What are your thoughts on Fastly and Neo? Fastly, it was very unfortunate what happened with this. I owned it, had anywhere between a 3 and a 5% position, but with this gap down, I just got the hell out of the way. Momentum investors use these big liquidity breaks. The fact that there's liquidity on the break, they use it to get out of their stock. Big growth, big momentum guys just can't hold something like this. And I talked in a video about a precedent for this, which was AYX, which was a very strong leading growth stock. Gave weak guidance on earnings on 8.7, and it gapped down, broke the 200-day moving average, and then just floundered underneath there for about 8 to 10 weeks before it got some clarity, some COVID clarity, and had a nice gap back up on 10.6. So personally, I get out of these as soon as I see a big break on volume, and that's what I did with Fastly. I actually sold it after hours when they announced this big gap down, and I got out around 88 to 89, and the big sign, if you have watched my gaps video, which is available out on YouTube, once you break sometimes gaps down like this get everybody out in one fell swoop. This one really didn't, and they usually don't if they're momentum stocks. You'll see a further break, and once it broke below the low of that gap day, that was your signal that this is going to need some more time. And you can see it's making new lows today at around 79 since that happened. NEO, I personally am staying away from Chinese stocks right now, but they don't really get better than this one. Very nice, multiple bases being formed, had a big gap out of the base on massive volume. If this wasn't a China stock, I would own it right now. But I'm waiting for the other shoe to drop as far as the U.S. Are they going to determine that Chinese companies listed on the U.S. have to follow FASB accounting standards? And if they do, a lot of these are going to get delisted, or they're going to have to really open up their books. So I understand there have been some strong ones lately. My favorite Chinese stock is JD. That's forming a very similar base to what's going on in the S&P 500, or sorry, in the S&P and the NASDAQ with the cup that they're forming right now. And it's also got the blue ball, which means relative strength is at a new high before the stock is at a new high. So JD is my favorite Chinese stock, but again, I don't own it. Would you define beta? Yeah, beta is just how a stock moves relative to how the S&P 500 moves. High beta stocks move more. So if your beta is 1.4 in a stock, that means that you move 40% more than the S&P 500 moves on a particular day. It's a complex calculation, and I kind of adjust it to calculate my beta by factoring in how ATR moves. What is the VIX term structure indicating now? It's indicating uncertainty because of the election, and it is very tough to read. I don't really mess with the VIX much because if I want to hedge, I hedge using inverse ETFs against my longs. Next question, will you employ any hedging strategies for the election? Yeah, not with options. I rarely use options, and we have a bunch of clients that don't or can't use them. So if we hedge, we're either selling or using inverse ETFs to lower our beta. I imagine I would drop my beta from a 1 going into the election because there's just going to be so much risk. And that this may be what we're looking at right now with this pullback, is just uncertainty and people wanting to lighten up on growth stocks headed into the election. Next question on gap ups. If you can't get the tail of the gap up, what's another place to buy into a gap up in general? Wait for a flag/pendant? Yes. Pullback using either the 5-day exponential moving average, the 8 EMA, or the 21 EMA is the next entry point that I look for on weakness, because they don't go up forever. They pull back at some point. Sometimes, like this, unfortunately, in JD, if you look at this, you really didn't get another chance. This went straight up. Another opportunity to enter. This is a very aggressive move, and you've got to be prepared to go underwater with this one, would be what's called a day 2 higher high. And that means after your gap up day with volume, what happens the next day? If you get another move higher, also on high volume, this is a big screaming buy for this. And notice that it never even touched the 8 EMA until it was up from, this was 70 to 86. So, and then it came back, broke the 8 immediately. This would have been the first normal, so to speak, add point, but notice what the market started doing. The market started correcting, and this stock is, JD moves a lot like a NASDAQ stock, and it's forming a cup very similar to the way the NASDAQ is, but it's showing more relative strength than the big FANG type stocks have been lately. CRSP, please. Yeah, this had two people that were at the forefront of this move won a Nobel Prize, and that was this gap up here. And then it had a failed breakout, another attempt at a breakout that failed also. I don't know if there was some news this morning, but this is down 10%. The positive is that it held the 50-day moving average. Always remember, if you're in a growth stock, your risk is always to 1 to 2% below the 50-day moving average on a pullback or a correction. And if it gets below that, I'm sorry to say, but it's just bad news for you if you're holding it. But so 1 to 2% below if you're still holding below today's low. would be a sell for crisp. So ugly day, massive volume. I don't know what the news was, but I'm not in this. Had a failed breakout, but growth stocks for about the last 3 or 4 days have been underperforming. RS rating Market Smith proprietary signal. Yes, it is. They cover it over. There's 3 ratings that they do. This is a 12-month. They also have a 6-month, and they also have a 3-month that show up in your search criteria as you screen for stocks. But yeah, relative strength. Now, the relative strength line is not proprietary. You can just take the price, like for example, on stock charts, it's just the ticker symbol : SPY or SPX, and that'll plot a line showing you the relative strength line, but the rating itself is proprietary. Would you dare take a small long in NKLA? No, this is a broken stock. To me right now, it just doesn't fit. It just doesn't fit what I'm looking for. It's got all this. This was the day that things potentially changed for them, when GM had the big volume gap up, but it was just the beginning of the end. It failed the next day, then it broke all the moving averages, then it broke the 200. Any rally up into the 200 is failing. Right now, I've read that this is really as much a business plan as it is a company, and I wouldn't touch this with a 10-foot pole. And let's see, it's 5 till, so we got time for a couple more questions if anybody has any. Otherwise, we're going to wrap it up. Thank you all for joining today. I'm going to have to edit the front of this because we lost the audio. But anybody that signed up for it, you'll get an archive copy of this. I know a lot of it was stuff that was reviewed about our process, but it's important that anybody follows us, understands fully what our process is, how we enter stocks and the market, how we get out of the market. And one final question. When you see a rotation from growth stocks into other sectors, do you look to buy in the non-growth sectors like UPS? Sometimes. We focus mostly on growth stocks, but UPS, the thing with UPS is, yes, it's not a typical growth stock, but it had the N in CanSlim on this big gap up, which was because of stay at home and COVID. They're just everybody's shopping online, and UPS, FedEx, and the U.S. Postal Service and a couple other ones, they've got to ship the packages. So this wasn't as much that it was not in a growth area as it was as that it became a growth area because of COVID. So, and it had the N, had its gap up, went sideways for a little while, made a higher high, almost touched the 80 MA here, went up again, and it's been beautifully holding the 21-day exponential moving average as it continues to go higher. Also had relative strength at a new high along with price. So that was a tell also that the stock could outperform, and it has. How do we quantify large volume? What is the threshold? Really, you want to see about, at a minimum, double average. But when you see something like is going on with Snapchat today, when it's over 1,000%, I mean, that's just monster volume. Let's go back and see what Facebook did in 2013. This is always one that I compare things to because this big gap up, the volume was 749%. If you see something over 400%, that really gets my attention. And Facebook, this was a big stock at the time. And if Snapchat is having its Facebook moment, more power to them. They're going to have to keep staying ahead of the competition. There is a lot of competition, but right now, Wall Street growth fund managers, pension fund managers, hedge funds are buying the hell out of this stock, as you can tell by the volume being 1,600% above average. So that's going to wrap it. Thank you all for joining us today, and you will get an archive copy of this. Have a great day, everybody.